There's an index called the MSCI Emerging Market Index. Investors use it to track the performance of stock markets in developing countries. And the idea is diversification. You put money into a basket of countries, let's say Brazil, India, Indonesia, South Korea, and Taiwan even, and you spread your risk around the world. Except something quietly happened over the past few years that nobody really announced. Three companies, TSMC, Samsung, and SK Hynix, all chip makers, now make up nearly 30% of that entire index. Add in two Chinese tech giants, and five companies account for 35% of what's supposed to be a globally diverse basket. So here's the punchline. Investors who thought they were buying emerging market diversification were actually buying a concentrated bet on the Asian semiconductor supply chain. And they didn't figure it out until the returns came in, which is exactly what we're looking at this week. Hi, you're listening to Beyond the Reefs, a show produced by Radio Taiwan International. Here we talk about socioeconomic issues that are faced by Taiwan and their broader impact around the world beyond the reefs of this island nation.
When people talk about Taiwan, they often talk about chips, but that's only part of the story. Behind the boom is something deeper, a massive supply chain of hundreds of companies building the machines behind the machines that make AI possible. NVIDIA, TSMC, and Foxconn are among the biggest names driving the AI boom. On the sidelines of Computex, U.S. chip designer NVIDIA's CEO Jensen Huang met with Foxconn chair Young Liu as NVIDIA continues expanding its footprint in Taiwan. The global push for AI is benefiting more and more companies here, but many other firms operate far from the spotlight.
There's companies, for instance, such as Kingslide, that do the rails for NVIDIA racks. That just really demonstrates that the solutions that companies supply here are very differentiated, and the market positions that they have in their respective segments can be very strong.
In Taiwan, many highly specialized suppliers dominate niche markets. Take, for example, Taipei-based Delta Electronics.
Now, Delta is the world's world leader in power and cooling solutions for the IT industry, but especially now for AI data centers. As you know, data centers, they consume a lot of electricity. So then Delta has the mission to help all these AI data centers to reduce energy consumption through its high efficiency power and also liquid cooling solutions and also infrastructure.
While Delta focuses on powering and cooling AI servers, Lydon specializes in powering and connecting them. Taiwan's AI advantage extends far beyond chip making. As companies race to build new data centers, demand is increasing for the equipment that cools, powers, and connects them. For Taiwanese suppliers, the next stage of growth will come not only from the chips themselves, but from everything built around them.
Now, before we get to the meat of the show this week, here is what's been happening in Taiwan. Last week, we looked at ASML, or ASML, the Dutch company with a monopoly on the world's most advanced chip-making equipment, and how deeply its operations are embedded in Taiwan. A quarter of its entire global revenue from one island. And we've been tracking that dependency story for a while now. This week, the numbers, they just keep coming in. Taiwan's manufacturing activity hit its highest point in nearly 5 years in May. The Purchasing Managers Index, a gauge of how busy factories are, came in at 61.4, its 8th consecutive month of expansion. Anything above 50 means growth, so 61 means that things are moving fast. AI-related supply chain demand is the main driving engine. The TAIEX, Taiwan's main stock index, closed above 46,000 points this week, roughly double where it stood just 4 years ago. And Taiwan's labor pension fund, the retirement saving managed by the government on behalf of workers, recorded a return of about $35 billion in April alone, smashing the previous monthly record by more than double. So everything is up. The question worth sitting with is, who's actually driving that, and do they know it? Computex wrapped up in Taipei this week. Computex is Taiwan's annual technology trade show, one of the biggest in the world, where chipmakers, AI companies, server manufacturers, and hardware suppliers come to announce products and signal where the industry is heading. Jensen Huang of NVIDIA was, of course, there. On the other hand, TSMC's C.C. Wei held his annual shareholders meeting the same week. The mood was, to put mildly, celebratory, and the numbers justify celebration. TSMC posted record consolidated revenue of about $121 billion in 2025, up nearly 32% from the year before. Earnings per share jumped 46%. C.C. Wei told shareholders that capital spending this year will come in nearly the top of a projected range, around $56 billion. When he was asked when that spending might plateau, he said, simply, honestly, he doesn't know. That line deserves more attention than it got. But before we get to that, the more interesting story this week isn't the TSMC numbers themselves. It's what happened to the money flowing around them. I'd argue the most underreported financial story of the week is this. The investors who made the most money on the AI boom weren't the people who bought NVIDIA or the big American tech companies. They were the people who bought emerging market funds, and most of them didn't even know that they were making a chip bet. Let's go back to the MSCI Emerging Market Index. That diversified basket of developing economy stocks has outperformed the Philadelphia Semiconductor Index over the past year. The Philadelphia Semiconductor Index is literally the benchmark for chip stocks. So the safe, diversified emerging market fund beat the chip-focused fund, and that's not supposed to happen. It's happened because the emerging markets fund became, without anyone formally deciding this, an Asian AI infrastructure ETF. TSMC alone now accounts for 14% of the entire index. Samsung, another 6%, and SK Hynix, South Korea's dominant memory chip maker, another 4%. Three semiconductor companies, nearly a quarter of what's supposed to be a globally diverse investment. Meanwhile, the Mag 7, the 7 largest American tech companies, the ones that supposedly are the AI trade, underperformed the emerging markets index this year. The value didn't accrue to the application layer, it accrued to the infrastructure layer, it accrued to Taiwan and South Korea. Now, this isn't an accident of one good quarter. It reflects something structural that's been building for several years. The AI build-out requires 3 things in quantities the world has never needed before: advanced logic chips, the processors that run AI models, advanced memory chips that feed data to those processors fast enough to keep up, and advanced packaging, the engineering that binds these components together into something that actually works. TSMC dominates advanced logic. SK Hynix dominates the specific type of memory AI needs most, called high bandwidth memory, or HBM. And the packaging, well, that's largely done in Taiwan too. So when the hyperscalers, Amazon, Microsoft, Google, Meta, spend hundreds of billions of dollars building AI data centers, the money flows to NVIDIA for chip design, and then from NVIDIA to TSMC and the broader Taiwan supply chain for manufacturing. The American tech giants get the headlines, Taiwan gets the orders. C.C. Wei flagged this directly at the shareholders meeting, though in careful language of someone who doesn't want to oversell. TSMC consumes nearly 10% of Taiwan's total electricity. It contributes roughly 25% of Taiwan's total tax revenue. Its market value represents over 40% of the entire Taiwan Stock Exchange, which I should mention currently stands at number 5 in terms of capital value in the world. At this point, TSMC isn't a company that operates inside Taiwan's economy. It's closer to the other way around. And the ripple effects are real. Taiwan's labor pension funds, which invest on behalf of the island's workers, returned about $35 billion in April alone, largely because of the domestic stock market rally. The TAIEX doubled in 4 years. Retirement accounts swelled. Financial firms that hold domestic equities booked record profits. And the wealth effect moved through the whole economy. And here's where it gets more interesting. Most of the Taiwan story this week is about scale. TSMC getting bigger, the index weighing getting heavier, the capital flows getting larger, but there's a quieter story running underneath it about a different kind of move. MediaTek, Taiwan's major chip designer, best known for making processors for smartphones, announced this week that it's entering the market for custom AI chips for data centers. This is a market that until recently was dominated by Broadcom, a US company. Google uses Broadcom to design its custom AI accelerators, the chips that run Google's own AI system, rather than buying off the shelf from NVIDIA. And this week, Broadcom publicly acknowledged for the first time that its clients are looking for a second supplier. That second supplier is MediaTek. Broadcom stocks dipped 15% on the news. MediaTek's CEO raised his estimate of the global data center custom chip market for 2027 from about 70 billion to 80 billion US dollars and set a target of 10 to 15% market share. 2 years ago, MediaTek's share of this market was 0. Now this matters because it changes the shape of Taiwan's position. TSMC's dominance is as a manufacturer. It makes chips to other people's designs. But MediaTek moving into custom AI chip design means Taiwan is starting to capture a different part of the value chain. Not just building what others design, but designing what others can't build yet. Now that's a meaningful shift. We've been waiting and watching for the signs of it for a while, and this week it showed up. Here's the complication though. All of this, the index restructuring, the record revenue, the MediaTek push, the pension fund returns, is downstream of a single variable, whether the American hyperscalers keep scaling or keep spending. TSMC's C.C. Wei said he doesn't really know when the capex plateau arrives, and that's honest. But the people who study the hyperscalers' balance sheet have a view. The projection is that Amazon, Microsoft, Google, and Meta, the four companies whose AI infrastructure spending drives the entire chain, are likely to see their free cash flow turn negative sometime in 2027. They're spending faster than they're earning. That's sustainable for a while because they can borrow, but at some point the growth rate of the spending has to slow, even if the spending itself doesn't stop. When that happens, the order flow compresses. Not collapse, just compresses. But in a supply chain where TSMC's capital expenditure plans are built on client projections that go out several years, even a moderation in growth rate creates real planning pressure. Taiwan can't change this. It can't manufacture its own demand. The constraint isn't technology or talent or even capital. It's the Treasury Department of 4 American companies. Now, layer in the geopolitical dimension, and here's where it gets genuinely strange. The US-China tech split was supposed to force Taiwan to choose. The logic was clean. Decouple China from advanced semiconductors, build parallel supply chains in allied countries, and gradually reduce everyone's exposure to Taiwan's geographic risk. Foxconn building semiconductor packaging in France, Taiwan firms scouting the Philippines, TSMC building fabs in Arizona, all of that fits the decoupling playbook. Except the decoupling isn't working the way it's supposed to. China responded to the sanctions by accelerating its own chip development. Huawei's domestic chip architecture, what analysts are calling the Tao process, is moving faster than expected. Chinese companies are routing chip purchases through Singapore and Malaysia, and critically, the US this week sent 17 top executives, including the CEOs of NVIDIA, Qualcomm, BlackRock, Visa, and MasterCard, to Beijing. Think about that and what that list tells you. NVIDIA and Qualcomm represents the technology supply chain. BlackRock represents financial linkage. Visa and MasterCard represent payment infrastructure. The US is not decoupling across 3 separate chains simultaneously. It's trying to relink across all 3 at once because it's discovered that a fully separated China is harder to manage, not easier. Cutting China off accelerated Chinese self-sufficiency. The cure turned out to be worse than the disease, so they're changing course. Taiwan sits in the middle of all of this. The forced labor tariff notice from the U.S. Trade Representative this week, which listed Taiwan among 60 economies that haven't yet banned goods made with forced labor, is a small but telling signal. Taiwan is being disciplined by Washington at the same moment it's being celebrated at Computex. Those 2 things are happening simultaneously because, well, Taiwan is simultaneously indispensable and exposed to the global markets. The U.S. needs TSMC. It also needs leverage over Taiwan. Those aren't contradictory positions. They're kind of the same position. 2 sides of the same coin, if you will. So here's the hypothesis. Taiwan doesn't strategize its way to the center of global capital flows. It got there by being the only place that could actually build what the AI boom needed, at the scale and precision that it needed, when it needed. Now, that's an extraordinary position to be in. It's also an entirely accidental one. The EM index restructuring is the clearest illustration. Nobody at MSCI sat down and decided to make the emerging market index a semiconductor fund. It happened because TSMC's market cap grew faster than every other emerging market company combined, until the index just reflected reality. Institutional investors worldwide, pension funds, sovereign wealth funds, retail ETF holders are now exposed to Taiwan in ways their mandate didn't anticipate and their risk model didn't price. And here's what that means. Taiwan's centrality isn't just a supply chain story anymore. It's a financial architecture story. If something disrupts Taiwan's semiconductor output, say a natural disaster, a political crisis, a sustained power shortage, the damage doesn't just ripple through electronic manufacturing, it ripples through global retirement accounts, index funds, and sovereign wealth portfolios. The blast radius has expanded well beyond anyone's original calculation. And TSMC's C.C. Wei knows this. That's arguably why his tone at the shareholders meeting this week was less triumphant than you expect. Record revenue, record earnings, but please continue buying shares, he says. Also, I don't know when this plateaus. And also, Taiwan uses 10% of its electricity just for TSMC. And we're worried about the birth rate at the same time. There are problems under the surface for Taiwan's economy, and clearly, now that could be problems shared around the world. Those aren't the concerns of a company riding a wave. Those are the concerns of a company that has become load-bearing for a structure much larger than itself and the country that it is in. So here's where that leaves us. Taiwan didn't negotiate for the position it now occupies. It built its way there, one process node at a time, over 40 years, and the world caught up financially, strategically, structurally, faster than anyone expected. And maybe that's the story of a small island that finally got the recognition that it earned, or maybe it's the story of a single point of failure that the global financial system has quietly built itself around and won't really notice until, well, something happens. The open question isn't whether Taiwan is indispensable. It is. This week made that undeniable. The question is, what happens the first time indispensable isn't enough? Picture a keystone, the one wedge-shaped block at the top of an arch that holds every other stone in place. Remove it, and the whole structure comes down. The arch doesn't fail gradually, it falls all at once. And when it falls, this show will be there to tell you all about it. Thank you for listening to the show. I'm Joey Cho. Tune in next week to find out more about socioeconomic issues that are faced by Taiwan and their broader impact around the world beyond the reefs of this island nation.